Hey guys, welcome. I'm Oren and this is the Game of Money. I wrote a special title for today's episode. It's super long, and it's, quote, how insiders get into the best money parties, eat the best free food, get free wine and beer, even IPAs, have tons of fun, dance, and then they go home and go to bed early, and you're not at this party because your invitation has the wrong date printed on it. What? So this week, I want to talk about the founders of CoreWe, which is a $23 billion AI cloud company that went public, and how the founders cashed out $500 million before their IPO. This ties into what's happening in the markets. This ties into tariffs. It ties into the IPO window. And this ties into the game of money. And it ties into the basically thing I care about most, and what this is about is the deep economy. So very likely you're listening to this because you operate in the shallow economy or the retail economy, above the line economy. And there, money is expensive, money is slow, money is hard to get. I was talking to the CEO today, trying to help him raise a little bit of capital. And he's like, I just want to know, I'm explaining like, how you go get money, how you put together the pitch deck, how you put together the financial model, how to get the money to come to you, where to, work your territory, all the things we do to actually raise money. And you're like, oh, I just want to know where the money is. It's like, it's like your sales guy going, hey, I just want to know where the buyers are. Well, you got to talk to a lot of people to find the buyers. So, the reason the title of this episode is how insiders get into the best money parties, eat the best free food, have tons of fun, and get to bed early, and you're not at the party because your invitation has the wrong date printed on it, is really to illustrate that people who have platform companies, who have venture capital, who have hedge fund capital, who know the deep economy, how money streams through the layers of the economy that you don't have access to as an entrepreneur. I hear everybody talk about this word. I'm an entrepreneur. Like that's not a job. It's not a thing. It's not a badge of honor. It's somebody that the second the company stabilizes, everybody's trying to get rid of. Stop calling yourself an entrepreneur. Look at an org chart of a real company. There's no entrepreneur. There's a CEO, there's a CFO, there's a COO, CMO, there's a VP of finance, there is a senior controller, junior controller, there's analyst, senior analyst, junior analyst, of the accountant, senior accounting, then there's outside consulting firms, there is sales, head of sales, everybody. There's no entrepreneur. That's not a thing. Stop saying that. Sure, Elon Musk, an entrepreneur. Yeah, but it's a one of one. There's like three of those guys. An entrepreneur is somebody who is searching around for money to stick it into a high risk idea and probably lose it on behalf of investors. All right. So this week, let's get into it. The founders of CoreWeave. It's a $23 billion valuation AI cloud company, cashed out nearly $500 million before their IPO. So let that sink in, right? These guys really treated the company as an exit ramp even before the exit happens, right? So they got paid before the company exited. So today on the Game of Money, I'm breaking down what this move really signals. Three of them made $150 million each. How people can take so much money out of a deal even before the company is exited and the other investors get to exit, and why people allow that to happen, and why regular investors keep getting played like this, right? Those guys get $500 million and you are stuck in the company if you're a private investor, and you probably don't have a easy trade once it goes public. So here's a quick version. CoreWeave started as a crypto mining company in about 5 years, which was super fast. They became the darling of the AI infrastructure boom. They landed contracts with Microsoft, with Meta, with Jane Street. The FTX guy, worked at Jane Street, then he started FTX and went to jail. Jane Street alumni, straight to jail. The revenue exploded from 16 million to 1.9 billion in 3 years, and their valuation, $23 billion. So, they started as a crypto mining company. They shifted into cloud infrastructure, even companies as customers, 1.9 billion in revenue, and did that in 3 years. So good job, super fast. And they did amazing. And so then they went to the IPO. The IPO buzz hits full volume. The founders quietly, and that is the word you want to listen to, quietly sell $500 million of stock before it goes public. So they'll have fundraising proceeds, right? Like that's secondaries. Insiders cashing out while Fidelity, BlackRock, and other big banks take their position. That good that the insiders cash out. Some people think that that's terrible. If you start a company as an entrepreneur, then you convert yourself into a CEO or CMO or founder, and you get on the org chart, that company grows to 100, 200, $300 million of revenue, $1 billion of revenue, and then you sell some of your shares before the company sells. Is that bad? To me, I don't know. You're over concentrated in that asset. This company is worth $23 billion. The founders got 500 million out. Okay, so what? The complaint is, why would these guys come to work and work hard if they have $150 million each? Buy a small island, get a PJ, personal jet, buy a small soccer team, and just retire. Why? Why would they come to work? Well, I'll tell you why. I mean, lots of people have $1 billion, $23 billion, 100 bucks. Jeff Bezos of Amazon, Elon Musk of Tesla, the government, Doge, Mark Zuckerberg, pick your choice. Larry Fink at BlackRock, the was running Goldman. Like, all those guys have $1 billion. They show up to work. They come in early. They work hard all day. They go to meetings. They take notes. They do their job. They go over spreadsheets. They get in trouble. They have to go to a Senate hearing committee and show up and pander themselves. So lots of people have $1 billion or more in cash, and they own islands and PJs and yachts, and they're like, I don't know, it's boring. I love work. So they come back to work. So I don't mind that the guys got $500 million and a $23 billion valuation before the IPO. Lots of people complain about it. The point is not that they got it or not, that they were able to do it. And that is called the deep economy. You're running an aquarium shop, a chain of paint shops, a ladder manufacturing company, a software code writing company. You make protein powder. You make barbells for Rogue Fitness. You run some CrossFit gyms. You run an IT services firm. You do software that runs, backup software. I don't know what you do. You repair cars. You have a string of repair shops. I need so many people. I met a guy just sold a pool cleaning supply distribution company for $23 million. I don't know what the hell you do, but it's something amazing, right? The point is, you got your money when you sold it. And until then, you got, if you had a $23 million food supply, swimming pool supply shop, that thing, maybe made $1.8 million a year. You had some kind of tax scheme and you took $900,000 out in cash. You made $900,000 a year, good living. You're not rich, don't have a PJ, don't have an island, not buying a soccer team. But in the deep economy, if you're giving me that company and I wrapped it with the kind of Teflon that allows it to go into the deep end of the pool in the economy, 90% of the company, 100% of the company, 80% of the company kept control of the company and taken that $23 million out. And with the PJ and the soccer team and the small island, still run the company. And so in the deep economy, you can tap into streams of capital you cannot get above the line. But no, they sold off a large portion of their holdings, to recapitalize and get this $500 million out. The founders still hold 82% of the voting power. Even though they sold just 30% of their ownership, they retained 82% of their voting power. Listen, I don't care if you're listening to me and you are just a sales guy, right? If you're a good sales guy, you're going to have a company someday soon, right? Because you're going to I don't like working for the man. If you already made that transition, you were a sales guy, you were an engineer, and now you started your own company, that company, ideally, to get good at it, and then you're going to have to do some finance at some point. But to sell 30% of your ownership and still retain 82% of the voting power, that's called a dual class stock with 10x vote. Wish I'd known that. I wish I had heard this podcast many years ago, and I'd be able to orchestrate a dual class stock with 10x votes, 82% of the voting power after selling down to just 30% of ownership. So think about it this way. You start a company with a couple of people, and you take in $5 million, that company goes to a valuation of $50 million, and you guys own $5 million with diluted. For that, you were diluted 30%, you got 70%. You guys go down to about 60% of the company by the time it reaches $50 million, right? Now, you take $30 million out of the company, then you take that money out, your ownership is diluted, so you're down to 30% ownership because you took money out. And that's how it works. But in the deep economy, with the cheat codes and the way of doing it, that is the dual class stock with 10x votes, even though you're down to 30% ownership, you retain 82% of the voting power. That is a nice move. And that's what you want to be able to do, at least know it's possible as you get into these deals. right? And so this is what I mean when I say retail buyers buy the story, and insiders who know the cheat codes, who know how to structure the deals, buy the PJs or the private jets. So not just CoreWe. This is what Adam Newman from WeWork did. He sold the company for $300 million. Sorry, he sold $300 million of stock before he sold the company in the IPO, and the IPO failed. All right. So he took $300 million out. You can watch it on Netflix. There's a show on it. And, that's a famous playbook. Reddit CEO sold $16 million of stocks before their public offering quite some time ago. Service Titan. So the point I'm making is there's a deep end of the pool. There's a deep economy where there's the insider angle. I just gave you one example of you go down to 30% of the company and you still retain 82% of the voting rights. Very cool. In absolute secrecy, people could see it, but it was still done. I'll give you an example from this week. I was on a call with an office that has put hundreds of millions of dollars into venture, into credit, into real assets, into private credit. And I asked them, hey, what are you guys looking at next? Where do you think the market is going? The tariffs are coming down. The tariffs in China, are hitting 145%. Obviously not sustainable. Israel, Italy, very likely UK. And if I have to guess, at a fourth country, Canada, right? The tariffs are not going to stick. Take Italy, right? There's so much Italian influence, from cars to culture to coffee to the way we live our life. We're not going to war with Italy and untether Italy from our economy and our way of life. These tariffs are going to resolve with Italy, right? So, I'd like to know what people are doing around these tariffs and what's happening with this crazy Ivan Trump administration. So the guy said, we're off the public markets for now. We only want deals where we can influence the outcome, or at least intimately know the people who are at the table running the deal, right? There's not a big picture around it. So they want access to deals that aren't trading sky high. What is sky high? 20x forward 12-month income. That's sky high. You don't have to know those numbers, but think about like what Tesla trades out with some of these, large cap or mid cap, super high tech AI or AI infrastructure companies trade at. Like, we don't want those deals that are priced so high, and we want to have a trusted relationship with the CEO and the founders, or we want some control features in the deal. It's not unusual. I talk to so many investors right now who have the mindset of, I want to know the CEO. I want to be involved with the company. If I'm not putting enough money to have control provisions, I want to be involved and see what's happening. I don't want to talk to them quarterly or halfly or annually. I want to see what's happening every week. Those are the deals that guys are looking for and finding. And they don't go on websites. There's no launch date on those. How it works is there's a group text, there's a voice note, there's a PDF, there's a one-pager, and that's it. And then the wire hits. So the deals that the private equity, family offices, guys who really are managing their own money are doing right now are insider deals in the deep economy. These deals don't even hit the market. They don't hit whatever website. They don't hit whatever group you're in. They don't hit your wealth manager. They don't hit your RIA. They don't hit anybody. It's just a bunch of insiders doing things together because they want to trust. Retail investors are hitting refresh on CNBC to see when CoreWeave, hit this IPO and trying to get some of that stock, thinking it's a big opportunity. It's not, right? Think about it. It's not a big opportunity. The founders of CoreWeave took $500 million out. While you're chasing that deal, they've already exited it. Will they show up like Mark Zuckerberg? Will they show up like Elon Musk, continue to operate the company even though they're, insanely wealthy? Probably, but maybe not. Right. But the point is, the $500 million that they got wasn't raising money. That was a harvest. They were harvesting the deal. So the shares that they got were sold in quiet. And no one told you about it. Right. And you didn't hear about it until, 3 days after the public filing. And so think about most of the time when you're getting these big deals, IPOs, all the deep economy, secondary, insider trades are done, and you're buying a product you don't even understand, and very likely it was harvested for the big money chunks before you got into it. That's the difference between the shallow economy and the deep economy. All right. So here's a wake-up call. Here's what's happening on the surface of the economy. The S&P 500 just had its worst year for buying the dip in nearly 100 years. So as you saw this week, boom, stocks fell, and you're like, oh, let's buy it because they can't drop this low without going back up, right? Retail investors who bought that after just a 1% down day, lost money consistently for the first time since the 1920s. I don't want to get specifically into the economics of the trades, but everybody understands, stocks magically, not magically, psychotically dipped because the tariffs, the crazy pants tariffs were announced on everybody, and it created instability in the system. Because if you listen to any news at all, from USA Today to NPR to Fox News to CNN, whatever it is, you've heard all this, right? The Fed did not really do anything, and so the government, was causing the volatility, not fixing the volatility. Last time you could buy the dip, it dipped because of some outside influence, either the real estate bubble, the 1999, .com collapse, the COVID bubble. And so it dipped, and if you timed it right, you could buy the dip because that stuff invariably came back up. But this time, the difference is the government caused the dip. The government caused the volatility. They're not going to cause the volatility and fix it. They're too busy causing it. Trump tariffs, rate hike head fakes, mixed signals. They're making the markets erratic, probably on purpose, right? So they can get into hooks into China. Meanwhile, institutions are pulling out of the public markets, moving into secondaries, private credit, and direct deals quietly. So again, institutions are pulling out of the public markets, moving into other securities like the things we talked about here, right? Not telling you about it, right? And so they're hedging against the government is doing, which is policy chaos. Pandemic was not policy chaos. The 1999 bubble burst was not policy chaos. The real estate bubble was not policy chaos, right? And so the government is causing this, and they're not able to control it. So you're not just buying rate when you're trying to buy the dip. A playbook has already been played out. So this is what I would say in the final analysis. This is what nobody wants to say. If you're seeing it on CNBC, right, and you're buying it, you're the liquidity that somebody else wants. If you're reading a TechCrunch article and you're jumping into that space, into that company, into that idea, right, into whatever it is, the insiders are already done with that game. TechCrunch is not a leading breadcrumb indicator or signal on what's working. They're a trailing indicator on what's working. There is one way into the front edge of where the money is really happening. You get close to the people who move capital in the deep economy, and you stay plugged in. So that's what this podcast is obviously about. That's what the newsletter that I have is for. So if you want to stop being the last person to know what's going on, and you want to start seeing how money really moves, I'm pulling back the curtain every single week in the Pitch Anything Playbook newsletter. And you know where to find it. Click on the links below, right? This is what the game of money is all about, giving you access to the Pitch Anything newsletter and making sure you understand, like, that's something you need. I'm not here to tell you what stocks are up this week. You can find that out on, Yahoo Finance or Motley Fool or Equifund or wherever the hell it is you find your stocks. I'm here to show you how capital really moves in and out of deals and why the public playbook is broken and how the insiders just play a different game entirely. Like, you don't even know. Some of the games that are played and getting money out of deals blow me away. And I know all this. I don't know all this stuff, but I do this. I have to do this stuff every day on behalf of companies, on behalf of CEOs, on behalf of venture capital groups, on behalf of myself. And then I see things, I'm like, holy coconuts. That is so cool. I can't, on this open line, give you, at the moment, like some of those super deep insider playbooks, because they're live, they're happening in real time, and if it gets out, everybody's going to know who the leaker was. It's me. So I can't be the leaker, but I know a lot of this stuff. So if you want to be in the front of the line, you want to stop being the last person to know about any of this, if you want to understand how the game is played before the headlines hit on Motley Fool, TechCrunch, Barron's, Bloomberg, or, the Rosenberg report. So I see the money move. And so I write the newsletter myself every week. There's no chat GPT. When you read that newsletter, you'll go, chat GPT did not write this. No AI came anywhere near this. Okay. And so for sure, you'll see I write it. Okay. Why? Read the newsletter and you'll know I wrote it. So no AI could be this, I would say, dynamic, bold, interesting, and messed up. So it's free, it's fast, and it's where I break down the deep economy every week. It's the world behind the story. So go to pitchanything.com, join the newsletter, and get a lot more of the economy. I'm Oren Clash, and this is the game of money.